Well, hello everyone. This is Roger Scott. I'm the senior trader for Wealth Press. And what do I always say? Let's get into it right now. So today is Tuesday, the 5th of May. I know. Where has the year gone? I'm still thinking it's January, maybe beginning of February, but we're not there anymore. We're not in Kansas anymore. That famous saying. All right, so let's talk about global markets. Let's start with the news, then let's talk about the sectors, and let's talk about strength and weakness. Today, we're going to focus on the number one sector right now, and there's been a change, so we got to talk about it. So starting with the world markets, world stock markets and price of oil rose on Tuesday as more countries eased restrictions on business and public life. Thank God. Raising hopes for a recovery from a historic economic plunge. Many European countries have seen new infections taper off amid strict social distancing measures. In Asia, China, South Korea were slowly resuming public events after months of contamination. Thank God. Move towards restarting economy stalled by lockdowns have raised hopes for a recovery in demand for oil, among other commodities. Crude prices plunged last month as price war between Russia and Saudi Arabia further roiled the markets. At one point, U.S. benchmark crude was priced so low that producers would have been paying customers to take oil away. It's true. I've never ever seen that in my life, but we were there. They say that if you live long enough, you'll see anything and everything in the stock market, and seeing oil prices go negative was one of those events. Now, this is a busy week. We've got a lot of earnings reporting. By the end of this week, we're going to have about 85% of the S&P report. By Friday, we've had close to 200, and we've got another 165, or close to 200. We're going to have quite a bit. So far, we went from expecting positive 4.4 to getting negative 12.5. Keep that number in your mind, 12.5, because if the quarter looks better than 12.5, the market should rally. If it looks worse, we should see some downside. On Friday, government will also show how many jobs were lost during April. I don't think those are going to be major reports because we've already seen 30 million people go through unemployment. So I don't think the numbers are going to get bigger. I think they're going to be within reason. And I believe the markets have priced the majority of that in. I think the markets are pricing in or trying to price in second and third quarter right now, and things are not looking pretty. So, looking at the S&P 500, let's look at the futures so you get a really good sense of what's going on right now. So, if we're looking at the indices, and if we look at the S&P, the liquid month, which is June, let's take a look here. Let's get down to the nitty-gritty here. We're almost, this is intraday, it's very meaningless. Looks like we almost hit the 200-day moving average. The blue line is the 50-day moving average. It's really not relevant right now because it crossed below the 200-day. So once it crosses below the 200-day, the only reason it would be relevant is if we're picking short trades. The only other time it would be relevant is if it was above the 200-day moving average. But if it's below the 200-day moving average, all we really care about if we're looking for the long side is whether it's above or below the 200-day line. The main culprit is the 200-day line. The 50-day line will always follow, but keep your eye on this ugly mustard-colored line. I made it ugly mustard-colored on purpose so you never forget it. So anyway, we looked like we almost hit the 200-day line, and then we started backing off. And I believe, and I've said it before and I'll say it again, I believe that this reaction, the reaction that happened between March 25th, give or take, and the current period, pretty much the entire April, that pickup where the market went from 2,180 to close to 3,000 when it gained about a third of its value in a month, that bounce back, that V-bounce we saw, I didn't think that was a reaction to what's going on in the markets. I thought, and I still believe, this is a reaction to what happened at the sell-off. This is a reaction to the sell-off. And finally, now we're going to get a reaction to the market because we're still assimilating a lot of the downside. We still don't have systematic testing. We still don't know exactly what percentage of people are dying. We don't have a vaccine. It's still too early to figure out how bad things are, especially as far as the stock market is concerned. Because remember, what's happening now in China, or what happened a month in China, is going to impact an American company 4 months from now. Imagine a little piece, a little part, a little plastic part that's made in China, and you need it to finish off a Tesla car that's put together in Mexico, for example. I mean, how are you going to do that, right? The supply chain is completely messed up, and it's going to take several quarters to get it back up. And I think the stock market only now is going to start thinking about that. And I believe this this comeback that we've seen was just simply a reaction from the steep correction where the stock market went literally in 1 month from 3,400 all the way down to 2,100. It needed to cool off, and it did. It came back up, and now it's saying, wait a minute, now where do we stand? To give you a good example, imagine a car accident. Imagine a car hits a wall at 60 miles per hour, and you make it alive. You get out of the car, you jump out, you make sure you're okay, and then like within a few days, things start hitting you. That's kind of like where we're at right now. I think the reaction that we've seen over the last month has been that reaction, that getting out of the car. Hey, are we alive? Is the world still moving? Can I see? Can I hear? Is my head okay? Am I bleeding? And I think now we're going to start getting into the, oh, well, how bad is it? I think that's where we're at right now. And that's why I believe the S&P 500 never made it above the 200-day moving average. Now, we've got a lot of negative earnings. We've seen biotech earnings come out. Those are positive companies because people need technology right now. But what about real estate? What about REITs? What about REITs, real estate? What about commercial real estate? What about material stocks, production stocks, utility stocks? They're not doing that great. How about retail stocks? Have you guys gone to the malls lately? No one has. That's the point. All of those earnings are going to start coming out next few days, and I think that's going to weigh more on the S&P 500. Now, if you look at the indices, though, notice that the S&P 500 was trading below the 200-day moving average. But if you look at the Nasdaq, 100, you will see that the 50-day moving average and the 200-day moving average just crossed less than a week ago, where with the S&P, they crossed all the way back here like a month ago. And we're still trading above the 200-day moving average. We're actually trading above the 20-day, I think that's the 20-day EMA, that other yellow line. Craig always posts stuff here that I don't know. He's sneaky like that. You got to watch him. Yeah, that's the 20-day EMA. We're trading above the 20-day EMA. So while the S&P is bearish, the Nasdaq 100 is bullish. Now, why is that? I'll tell you why. These are all the sectors in the S&P 500. The Nasdaq 100 only has a majority of technology, healthcare, and consumer discretionary. It doesn't have a lot of consumer staples, materials, utilities, real estate, industrial, energy, and financial. It's got a little bit, maybe a couple of stocks here and there, but that's it. S&P's got like 50 financial stocks, 50 energy stocks, 50 industrial stocks, utility stocks. Those are all pulling the market lower, and the Nasdaq doesn't have them. There's none of those stocks in the Nasdaq. The Nasdaq's got the technology, healthcare, consumer discretionary, and they're moving higher. Now, the last few days we saw healthcare trade above technology, but technology is back. Earnings for technology, I think close to 70% of earnings in the Nasdaq 100 beat the estimates, where only 48% in the S&P beat estimates. Momentum levels in the Nasdaq are looking better. Fundamental levels are looking better. Technology is looking better. Volatility is looking better. Option premiums looking better. The Nasdaq looks like it has a chance of really getting out of this, all because of these three sectors: technology, healthcare, and consumer discretionary. And I'm going to tell you, technology and consumer discretionary are, they're kind of like mixed, because is Amazon technology or consumer discretionary? Is Apple consumer discretionary or technology? You see what I mean? Semiconductors are technology, but a lot of these technology stocks are not really technology stocks. They're in consumer discretionary and technology. So again, technology is now leading again. Earnings were just stellar, and we're now moving into other sectors, so they're not going to change very much. So I like healthcare, and the reason I like healthcare is because it's not a consumer-driven market, and society is not going to be it's not going to be consumer driven for some time. It's going to be government driven, and government is going to put a lot of money into healthcare, government grants, government loans. Government wants to find a vaccine for corona, and they're going to be putting as much money as possible into health. So we are going to see health go up, but I think technology is going to keep leading the way. Now, if you want to know which technology, let me give you a little extra today. I always like to give you a little extra. So technology is the number one sector that I'm really liking right now. And let me show you, out of all the tech stocks, which ones are leading right now. Netflix. Netflix is hot. Nvidia is hot. Amazon is hot. Notice all of these stocks take advantage of the stay-at-home economy. Amazon, obviously. Netflix, obviously. Tesla, not so much, but Tesla is just a monster. I think Tesla's honestly overvalued right now. But I like Netflix. I like Nvidia. I love Amazon. Citrix Systems is a competitor to Zoom. It's when you want to have virtual meetings. Great company. PayPal, amazing company. Microsoft just came out with positive numbers. eBay just hired the CEO from one of the largest companies to be theirs. There are going to be a lot of changes in eBay. JD, Chinese e-commerce company. So you've got all of these techs that are really, really strong right now, and that's the sector I'm looking at. I'm looking at the Nasdaq 100, which is primary tech and growth stocks, and the stocks that are causing the upside right now in there are Netflix, Nvidia, Amazon, Citrix, PayPal, Microsoft, eBay, JD, and ATVI. Those are the main culprits. Now, I've got something for you. Remember, there's no need to panic in this situation. If you have the right strategy, regardless if markets are going up or down, there's always stocks that are making 52-week highs. And this isn't just about protecting your portfolio anymore. It's about making obscene profits. It's about getting an unfair advantage in this market, folks. And it's possible with jump trades. That's right. This strategy has proven to make money regardless of what the stock market does. It doesn't really matter. It's not correlated with the stock market. Stock market goes up, stock market goes down, stock market crashes, stock market rallies. It doesn't matter. Non-correlated. The best thing you can do is diversify your portfolio. Jump does that right away. If you wait any longer to take action, don't be surprised if you get hit by a major loss. Take control of your returns starting now. Gain an unfair advantage in this market. Click the link below or the button at the end of this video to start profiting now. Jump trade, gold, currencies, no correlation with the stock market. The worse the stock market gets, the better gold and inverse currencies gets. Folks, we've had a 12-week winning streak in a row just recently. You do not want to miss out. Follow the link below. Learn all about jump trades. Gain an unfair advantage in this market. Let diversification work for you. Talk soon. Bye.